Kyle Rodda, market analyst at IG Markets. Kyle, thanks so much for your time. Look, the US government is trying to reduce oil prices by releasing its strategic oil reserves up to 1 million barrels a day. How much impact do you expect this is going to have on the oil market?
Well, I mean, really the core concern is obviously what's happening in Russia and Ukraine. So at the end of the day, how that conflict evolves will be really the biggest driver behind what happens in global energy markets and global oil prices. But this move just right now that we've seen from the Biden administration has had a pretty significant impact on oil prices. We saw them down 6% yesterday on that announcement. And it is a pretty significant increase in supply into global markets and sort of navigates, for the time being, some of those issues that we have faced by the fact that so much of Russian energy exports have been cut off to the rest of the world. And of course, there are these major disruptions to freight and supply throughout that region that is pushing up or has pushed up prices to levels that haven't been seen for over a decade. So, it has a material impact, but at the end of the day, it is going to depend on how this conflict unfolds in Russia. At the moment, in Ukraine. At the moment, market participants are reasonably confident that peace talks are progressing well. But if that deteriorates and we do see Russian exports cut from the rest of the world, it will probably negate a lot of those efforts from the US government and lead to upward pressure on prices. So it's still a very, very volatile environment for energy markets.
Yeah, Treasury modelling in the federal budget this week, they expect oil prices to be $100 a barrel in September next year. So surely that still means there's quite a lot of upside for Aussie oil producing companies.
I think so. And if you look at what's happened across the energy landscape for the better part of 10 years, is that there's this sort of ESG discount that's been priced into a lot of these stocks because everyone was expecting that these companies would be slowly become obsolete as we move towards more green and renewable energy. That's been pretty much priced out of these stocks right now because it's become clearly apparent that with energy security a major issue now across the world, we're leading to this sort of multipolar environment where you've got the US and Russia, US, China, all these sort of different fractures that are emerging that are threatening obviously energy security, and the move from the Biden administration in the last 24 hours is a little bit of indicative of that, is that still fossil fuels are required, still oil is required as a major source of energy for the global economy. And in a high inflation environment as well, there is this just general demand for commodities right now as a way of trying to hedge that risk too. So, there is the notion now that our energy companies are going to really benefit from these high oil prices, again, because of those geopolitical as well as more sort of structural environmental concerns. And we're starting to, like I said, that big discount that was priced in because of, that move towards renewables is going away very, very quickly. And investors are starting to really enjoy the upside that's coming from a higher oil price and higher shares in the energy sector.
Okay, let's talk Reserve Bank. They've obviously just appointed Michelle Bullock as Deputy Governor. Do you think this makes her the likely successor for Phil Lowe, the current Governor of the RBA?
Well, history says that's the guy, but I think what was really interesting was that Guy Debelle actually left the role, or the former deputy left the role before really, the opportunity to have a run at the role. Typically, you do see the deputy move on to, becoming the governor and then taking the reins for the better part of a decade, or the several terms that they do get allotted to them or allowed, depending on circumstances. But I don't know if this sort of circumstances might marry up going forward into the future, just on the basis that both sides of politics have put a lot of scrutiny on the RBA in the lead up to this election, and both pledged that there'll be a review of the central bank afterwards, mostly on the basis that they'd missed their inflation target, they'd missed a lot of their key mandates for the better part of a decade. They're starting to reach it now. But there's seen to be some sort of institutional failures and perhaps a little too much kind of groupthink going on in the institution, and maybe it requires a little bit of a shake-up. So there was the argument that Guy Debelle's departure indicated that maybe he wasn't going to cruise into that job, and that he's taken on opportunities in greener pastures as a result. So it's not necessarily assured. I think there'll be a lot of scrutiny on the central bank going forward. Obviously, Bullock will be in the front seat when it comes to the time that Lowe's tenure expires. But I think there will be, a little bit more, again, scrutiny on the RBA going forward, and there won't necessarily be that kind of clear runway into the governorship for Bullock as there was for Lowe and Stevens and all the predecessors in the last sort of couple of decades.
And look, just on the RBA, they've obviously got their cash rate decision next week. Where do you see inflation at the moment? Is it high enough for the RBA to lift interest rates before the federal election?
Well, the short answer is no, probably at this meeting that we've got coming up or the meeting in May. But there's a bit of a technicality to that in the sense that much to the, I think, frustration to a lot of market participants, economists, and there's a lot of debate as to whether this should be applied now, is that, you know, our CPI data comes out once every quarter, unlike other parts of the world, which is once every month, like say in the United States. So the numbers that we've got are actually from, you know, the December quarter last year, which, you know, showed inflation around, you know, 2.5, you know, a bit above 2.5% in terms of, trimmed mean inflation, which is basically in the middle of the RBA's target band. And we've also obviously got the unemployment rate at around 4% right now, which is, you know, pretty much close to a full labour market, depending on which way you look at it. So right now, the RBA doesn't have the data support to hike rates necessarily. The counter to that, though, is, of course, we're starting to see in the more forward-looking numbers and obviously anecdotally and what have you, that inflationary pressures are starting to build, and everyone is forecasting that inflation is going to pick up throughout the year and, you know, eventually lead to interest rate hikes from the RBA. The RBA has pushed back. They said the rate hike this year is a plausible scenario, but said it's not their baseline. If you look at what most market economists are saying, they're forecasting maybe 2 or 3 rate hikes before the end of the year. If you look at the interest rate markets, which is what traders price in, you know, you're looking at potentially 7 rate hikes before the end of the year, a cash rate that ends up between, you know, 1.75 and 2%. Again, that's market pricing. So right now, the RBA can push back and say that they don't need to hike rates because the data doesn't say it needs to, but the data's old. The forward-looking indicators are suggesting that there is inflation coming and it will overshoot the RBA's target band. And again, economists and market participants are expecting that rates will rise and probably rise reasonably quickly this year.
Kyle Rodda from IG Markets, thanks so much for your time. Appreciate it.
Thanks for having me.